Okay, what's the secret to growing your account quickly, but also responsibly? This video gives you that answer. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City since 2005 and proud to develop number 7 and even 8-figure per year traders. Watch, take notes, and learn from a professional trader on our desk so you can grow your trading account.
So it's no secret we've had volatility, and because of that volatility, we've had a lot of traders, getting some good performance. We're here with Carlton, who's our risk manager, and we wanted to ask him a couple things because he's noticed some very specific practices that traders have incorporated into their trading, and we're hoping that these three things will really help you. The third one's kind of a surprise, actually. When Carlton was putting together a list, I was a little surprised by the third one. But, we'll go through them, and they're really good best practices. And you may have heard something like it before, but, hearing it from somebody who manages the risk of the traders on our desk who are outperforming even some of their own expectations, it kind of really brings it home. So, Carlton, could you help us understand what was the number one thing that you felt like traders needed to do to make sure they're building their consistency, make sure they're managing the risk properly, and most importantly, preserving their ability to grow their account quickly?
So most important thing I would say is rule one is protect your green days. As far as when you're a new and developing trader and trying to get to that next level, the most important thing is protecting those green days, because as we know, the market spends more time chopping around and not trending than actual trending days.
Yeah.
And usually what happens is most of the times we're seeing an average day in itself. And this is all where traders tend to lose the most money, on those average, trading days.
Yeah, so you'll see somebody on the desk who's, pushing for new highs. They're pushing to get their P&L in the right direction. They're trying to make that next big step, right?
Mm-hmm.
And what I'm hearing you say is they'll turn a normal day and they'll look for more than what's being offered by the market. And then most importantly though, they won't protect that day being green. Maybe they got into one good trade or two good trades or three good trades, and they've got some momentum in their P&L, and they're trying to push it on a day that isn't there. And that's okay to push it, but it's not okay to push it and try and make $200 but give back, $2,000 of what you've made on the day.
Exactly. And that's something that's hard, that traders, it's a hard rule for them to really digest and understand, is for them to really just understand, look at the opportunity set that's presented themselves in the morning. Just like, for example, when you do your daily review. From a risk standpoint, you should say, okay, today is a day where I'm looking at all the checks in my boxes, just as a pilot would have for his flight plan before they take off. You're doing the same thing as a trader. You're checking all your boxes to see what the opportunity set is on the day. And if it's deemed an average day, what you're doing is just looking for those singles and doubles, those base hits, right? Trying to protect that P&L and trying to protect that consistency. So again, if you understand this, quite simple math, there's about 20 trading days in the month, right? So if you're up $100 every day, right, for that month, that's easily $2,000. And again, the same thing, if you were able to turn that consistency into $1,000 per day at the month, what is that? $20,000. So again, it's not really in itself. You're not doing anything different in your setups in itself. It's all you're doing is scaling your risk. Once you've built that system in, once you've built the playbooks in, once again, really been getting those reps in. That's one of the most important things on how you're scaling your risk, is protecting those green days. That's really most important in building that baseline. That's most important, and that helps keep you grounded and get you to that next level in your trading career that you're looking at, or turning the corner in your trading career if you're just trying to get to consistency. So a lot of people really don't understand how important it is for a new developing trader to develop that consistency and those green days. Even if it's $10 green days, if you take that and all you do is leverage that up, you add your risk after 2 weeks or 3 weeks or 4 weeks, that $10 day turns into a $100 day. That $100 day turns into a $1,000 day. That $1,000 day turns into a $10,000 day. So few people really don't understand that simple concept. So I think that's really important to really hit home for new and developing traders and people trying to find consistency.
obviously protecting your green days, making sure you're building consistency by doing that's really important. You mentioned something else when we were brainstorming for this, and I thought it was like really important because I've certainly experienced it and I've seen the trade. I'll tell you a quick story about the desk. So there's this trader on the desk who yesterday was really trying it for this symbol, and he had the setup that he wanted. And he really thought he was going to nail it, and he just he tried it twice and then tried it a third time, and he was doing everything right. He was taking good trades. But the reality was he probably should have just stopped because it wasn't the day for that symbol. So you mentioned this just kind of offhand of I don't understand why he didn't just have his per symbol risk limit set, right? That seems like a really simple thing. Help us understand what a per symbol risk limit is.
Just like you have your daily stop in itself, you want to have a per symbol risk limit. And what that's clearly defined is you have your daily stop and you assign a certain percentage of that daily stop to a maximum loss in a symbol. So for example, if you're trading Apple or if you're trading SMCI, and let's say we're just using basic math here, basic numbers, right? And you say your stop is $100 for the day, right? At maximum, what you want to do is make sure that you're not losing more than 50% of your daily stop in a symbol. In most cases, on an average day, I would probably say roughly about 30% on an average day per symbol. And what that really stops you from doing in most cases is there's sometimes where people can't just get away from a stock. They get wrapped up in trading a stock and they don't understand that the stock that they were trading yesterday is not the same stock that they're trading today. So it's really, really important for you, especially for new and developing traders, to make sure when you hit that maximum stop per symbol, that's it, you're done trading the symbol. And that can help you from preventing drawdowns intraday, over trading, going on tilt. And that's usually where new and developing traders go wrong. It's not on it's just again a trade that they planned out and said, okay, this is my breakout setup, this is my support setup, this is my big dog setup that I'm trading. No, what happens is they trade a symbol, then they continue to trade it again, and then they trade it some more, and then before they know it, they've blown through their stop or again exceeded a reasonable amount to lose in a single symbol. So this is why it's important for you to make sure that you're setting a per symbol loss limit for any trades that you're putting on each day. So that's a part of your trading plan.
Man, how many times have you seen somebody put together a good couple trades, 2, 3 good trades, and then all of a sudden they lose all of that plus in one symbol?
I'm going to stop you right there. All the time. New and developing traders, all the time.
So they'll make money trading setups that they have edge in, trades that they have edge in. Then it'll be 11 o'clock or 10:30 or even into the afternoon. Maybe it's something that occurs in the afternoon. They don't lose it in the middle of the day. But then all of a sudden, it would be like somebody making money counting cards and then taking all that money that they made plus everything they had that they were willing to risk initially and then going and saying, I'm going to bet it all on Black 33.
And compare this, again, just to playing Russian roulette. You have to remember also, and especially when it comes into earnings season, when you have so many symbols moving earlier in the day, we don't realize sometimes these stocks maybe need to slow down. They need to, find some type of, and so either consolidation or pullback. Also, volume is coming in and volume decreases. Very, small instances where we'll start to see extreme volume unusual volume still coming to the stock in the middle of the day. But usually in that midday session itself, volume is coming in, stocks are pulling in, or they're not having that same type of follow through. And traders tend to, or new and developing traders, I should say, that have not experienced markets, that have not properly planned for each session throughout the day. So that's why I say it's important for new and developing traders to break a trading day into 3 days where you have the open, the midday, and the close. And in itself, that daily stop is where traders tend to, new and developing traders tend to exceed that stop because they just continue to trade the stock midday as if it was them trading on the open. So it's really important to make sure that you keep a per symbol loss limit for any trading.
All right. So move your stop up to protect your green days.
Correct.
Make sure you have a per symbol risk limit. So every symbol you trade, every idea that you have a max amount, you have a budget for what you're willing to lose or risk on that day. The third one was the most interesting one. I was almost a little surprised by this. And maybe it's because you're now down in Miami, so you're not in the New York office anymore. You're running the Miami office. And maybe you found a little more balance. I don't know. Maybe you like it up here a little bit more. But we were talking about what really successful traders are like off the desk.
It's important to know that as far as, again, being off the desk, having some type of outlet outside of trading. Because again, trading is something that's definitely can consume you. So, for example, Dan G, one of our top traders here, he likes to travel the world. Again, you call him, one day he'll be in Germany, the next evening he'll be somewhere in Spain. Or again, I call him the traveling trader. That's his outlet. He loves to travel. He loves to absorb different cultures.
Now, is he one of those guys we'd see on Instagram on the beaches, pressing the button once a day, and he's living a beautiful life?
You'll be surprised at the some of the pictures and video calls that I've shared with him, with his trading setup. Skiing midday, and again with his temporary setup, in trading into the close or trading in the open. So yes, again, having that outlet, and that's fulfilling for him.
Yeah.
And trading helps create that outlet for him in itself. Someone like Swang, he definitely likes to enjoy socializing. He enjoys networking, talking to his friends, being around people. And again, trading offers you that ability and opportunities that you can do many things outside of your out of trading in itself. So that's one thing that's really important.
And you're talking about essentially risk management from who you are as a person. If you're not coming in fulfilled every day, if you're not living a life that you feel like you're really proud of, and then trading's fitting into that, it's a part of that. You're more likely, we'll see traders on the desk burn out. We'll see traders start to force things because they're trying to put their views of who they should be on the market. All those things that really are mistakes because they're really hard to get around, right?
Just for example, like a new and developing trader like Brandon S. Again, he loves to go to the gym. That's his outlet. He loves to go to the gym. And then outside of that, also he likes to socialize with his friends, have a good time. And some of his friends are traders on the desk itself, and they do that together. So these are important things to make sure that make trading, fit your life and not be your life.
This is coming from the risk manager. So at the same point, when you're actually going to put the risk on, be very focused. Don't be screwing around with all the other stuff. There's a time and a place for that. And then you come into trading and you're a better person, when you're trading, if you're a better person outside of trading. We were done shooting and Carlton said, no, we have to talk about this. We can't leave this out. Tell us about the Giveback rule. Yeah, tell us about the Giveback rule.
Each trader should be intimate with their stats. You should know what your average winning day is. You should know what your average losing day is. Okay. And understanding the market environment for the day that you're trading in itself. And again, if you exceed your average winning day by 1.5 times, you should automatically put in a 30% give back rule. Or if you hit that average day as far as P&L, winning P&L that you have, you should make sure, again, you're not giving back any more than 30 to 35%. And just like you would add a trailing stop to a stock that you're in, the same way you have to add a trailing stop to your trades that you put on. That's really, really important to make sure, again, not turning a winning day into a losing day, because that in itself can be worse as far as in the on the mental side and the psychological side of your trading. Because how many times have you, again, even if you lost $100 in a day, but if you were up $1,000 on a day and you ended the day at down $100, how does that make you feel?
Yeah, not great. I've been there. You've sent me a G chat when that's happened. But yeah, no. So what I hear you saying is look at your average winning day. And when you're up more than your average winning day, that's when you implement the give back rule.
Correct.
Okay, great. All right. So you're protecting your average winning day. So it kind of fits into the green days, protect your green days, but this is a little more specific than that, right? So it's helping you string together and protect those times when you're trading well. when you're trading above average. So it's protecting your psychology while you're trading above average.
And trading psychology is so important because if you think about it, again, us pushing the buttons, that's just maybe the 10%. The other percent is just the preparation and psychology.
Carlton, thank you for these 3 points. Thank you for everything you do for us. Thank you for helping us better manage our risk, both with our trading and with our lives.
Thank you so much for having me.